What's going on, team? I'm super excited to talk all about Netflix. I know that you guys probably already have seen the stock pop. We've gotten to a high in the after hours. I have 345.64. We'll get into all the earnings. Let's go ahead and meet the man behind the plan of it all. My man, Nick Brown, stepping up to the plate. How we doing today, Nick?
I'm good. How are you? It's been one of those days. It's been a crazy day.
That it always is. It's the market, right? We always are looking for the next catalyst. Today, we got Netflix earnings. So, what we're going to do is go ahead and let you kind of give what you saw in the earnings. I'll let you do the rundown. Then we'll get into the technicals, team. I'm also going to throw up for you guys in the chat our recap article. If you guys want to check it out, go ahead and check it out right now on benzinga.com. It's right on the home page, but I'll give you guys the link here. What are you seeing right now in the earnings, my friend?
It was a pretty good quarter for Q4. Adjusted EPS, 12 cents. They did miss on the EPS. Estimate was for 42 cents. Adjusted revenue, 7.85 billion, roughly in line with the estimate, 7.85 billion. Streaming paid net change, 7.66 million. The estimate was only for 4.5 million. They did give some guidance. Sees Q1 EPS 282, estimate was 299. And Q1 revenue 8.17 billion, and the estimate was for 8.17 billion, so right around in line. Netflix does plan to resume their share buyback in 2023. They expect to roll out paid sharing more broadly later in Q1. But I think the major news that everybody is pondering right now is co-founder Reed Hastings is going to leave the role as co-CEO, become executive chairman. And Greg Peters has stepped up from COO to become Ted Sarandos' co-CEO and a member of the Netflix board. Trying to go through the comments here that they are saying, basically, this was a pretty good quarter. Not many people expected them to beat on the net change. We now know that they no longer give the guidance of what's going to come for the numbers, who is like watching, so how many they had. So they're going to give the paid net change. So you can no longer look underneath the hood. They're just going to come out and say, hey, streaming paid net change, there's what we got.
Yeah, it seems like, of course, everyone has always looked for a subscriber, right? What's going to come for the subscriber? Well, at least when we look at it this time, and I had talked to you about it before on At the Close, we were looking at the estimated EPS, right? And we had talked about how there had been big beats, right, in that EPS. Well, now you guys are seeing that EPS come down fast here and missing pretty big off of that EPS, right? And I think that's something to notice here. Of course, one thing that we've talked about also, how the kind of the revenues have come pretty much in line, right? Those haven't been missing too much. You guys can see that. Not even off by 1% in the last like 6 or 8 quarters. So that just shows me more and more that revenue wise, that's not changing. It's more the earnings per share. So what is happening here, right? Probably margins, right, are being affected. And so things that we need to kind of keep in mind, right? When we looked at the earnings, there's also the forward guidance. That didn't seem too bad. Not too off there, right, Nick? Did you already give the forward guidance?
Yeah, I was going to say Q1 EPS 282. Estimate was for 299. That's not really a big change. That's what, almost 17 cents. Estimate for revenue was 8.17 billion. They said we're going to see 8.17 billion. So I think it's just the guidance. It's okay, but everybody's pondering the net change and that Reed Hastings is like moving to a new role.
Yeah, that's big, right? When you're getting bored changing, and especially someone as high as Reed Hastings, right? Co-founder to leave his role as co-CEO and become executive chairman. What does that actually entitle, right? That's all the things that we need to be thinking about, right? What will his executive chairman role be? And I think that we need to start thinking about what really Netflix's plans are for growth, right? Because when we think about it, that's where the questions are starting to come, because we started running into issues when we started hitting those negative subscriber numbers. Then we get a positive subscriber numbers, and now it looks like they just pulled the rug from the number overall. So it looks like we're not going to be getting that subscriber number. A lot of people will be thinking, right, is this more based on the ad tier? right? Is this why we're not getting subscriber numbers, right? Because there could be some people, maybe let's say dropping from the premium tier to the low tier, right? And what would that count as for the subscriber, right? I think that a lot of things could be factored in here and why they're not wanting to give us subscriber growth. On the last earnings call, one thing that I could clearly hear is the focus for what? For profitability, right? And that's where their focus is going. Well, not looking good when your EPS is missing by that much now, if that's where your focus is. So it's interesting that though that we still got the pop, right? Because if we take a look, let's get into the technicals. Let's take a look at the chart. Netflix still getting a nice little lift, getting up there towards the 345.64. But since then, it quickly leaked back. We'll see if we can get back above, especially let's say even the 340s right now. Seems like we got that nice pop. Let's see how it also affected other kind of stocks. We'll get a little bit deeper into the daily chart of Netflix, see how this could affect a longer term trade. But let's take a look at like a Disney, right? Disney sometimes gets quickly affected by this. You guys can see that pop, shortly lived, right? Right back down. So that's one thing to keep in mind. We'll see what happens there. Did it affect a Roku? Let's go ahead and take a look. There you guys see it. Relationships, right? We'll see what happens to this. Looks like Don grabbed some calls right before the close. I don't think Don's too mad, but we'll see because it's tough, right? It had an expected move. If I'm to be quoted, I think the expected move was about $28. So definitely just to be careful out there, especially when you're not getting that big of a move for an expected move. The premium's usually into those options. I try to stay away from those options on earnings, but like always, Don, if you're able to make it, I'll just say, ring it when you can, right? Roku getting up there also, but this one looks a little bit better than Disney. At least it hasn't come right back down towards that low. Let's go back to Netflix chart. Take a look at the daily chart and how this affects there. Of course, what happened to this chart? Well, we started reporting, right? We got a negative number. Right? Now we've been climbing the wall back, the wall of worry. We made up this huge gap. I remember when for a while I just had a gap just drawn here and I was like, will we ever go back here? Well, clearly did, right? And that just shows us that we can climb the wall of worry. Netflix overall, now it's going to be more of a matter of profitability. How is that ad tier really working? And overall, can they keep their international growth? That's one question that I definitely will be having. Got to save that one. Maybe for Michael Pachter coming up, Nick, right? We do got Michael Pachter. Do want to let you guys know. Stay tuned, right? At around 5:45, we should be having Michael Pachter, equity analyst for Wedbush Securities, joining us. Let's go ahead and talk a little bit more about Netflix. So one of the things that I wanted to kind of get into really is more like Netflix growth drivers. And chat, feel free to kind of jump in here. We're going to go into more like discussion based talk about Netflix for investors out there. You guys in the chat, feel free to make some comments on what you think about these areas. And if you think there's real potential for long-term growth there, right? The first one that I would kind of talk about is the ad tier side, right? Did you see anything mentioned in the earnings or anything that you see out there, Nick, about ad tier?
Yeah, I was going to say in the release, it was about 16 pages long and still trying to pull from it because they do have some pretty good info. On the ad-supported tier, they say, quote, engagement, which is consistent with members on comparable ad-free plans, is better than what we had expected, and we believe the lower price point is driving incremental membership growth. We've seen very little switching from other plans. So it really goes to show that the ad-free plans, a lot of people are trying to avoid ads, and that's a lot of things with that are having problems with Comcast, Xfinity. When you go to on demand, there's a few, I don't want to say a few, there's a lot of shows that you cannot fast forward. You cannot bypass the ads. And so Netflix with the ad supported tier, if you're trying to get to a subscription platform saying, hey, I'm not trying to get with ads here. I'm trying to avoid them. I do think that the ad supported tier, I think a lot of people are going to be in the ad-supported tier. And when they try to attract new subscribers with the different movies that are launching or the different shows, the different episodes, whatever they're going to try to do. Hey, they may even do a discount saying, hey, if you're coming to the ad-supported, ad-free plan here, we'll give you like maybe a $4.99 discount to what it is now. They're trying to do everything here to attract subscribers because they do have other competitors. To the competitors could be Hulu, HBO Max. There's a lot of other competitors in this industry. Disney Plus, Apple, Apple TV, YouTube, Peacock, Amazon Prime Video, CBS. There's a lot of competitors and alternatives, and Netflix is trying to be number one in this industry.
Yeah, it's one thing that we need to kind of look into will be if the ad tier is really the solution, right? I know it's going to bring them some more revenue, but is that the solution, right, for their problems? I think they have been looking at different ways to kind of pull different levers, right? We heard for a while, and I haven't really heard anything like, massive come out of it. But what about Netflix and maybe like gaming? I mean, that is something that they talk about, right? They've been talking about gaming. They have mobile games, but really nothing that has taken off, right? Is this a growth driver for Netflix? I'm not so sure that they can compete with big names, right? I mean, in mobile games, maybe they can have some competition with some kind of smaller names, right, that are in the mobile players. But overall, are they going to be a big gaming name? I don't see them competing with like an Activision, an EA, a Take Two. Do you see them getting into anything like that, Nick? I don't see that happening.
No, it's going to be hard because then you have to compete with Sony too, and then the Microsoft Activision deal, like all these different mergers. It is going to be hard for Netflix to get into a business that I don't want to say that they're not in, but they are in just a little bit. They're going to have to do a lot of work and put a lot of money towards the gaming business and the mobile apps instead of trying to focus on this ad-supported tier of how they can regain subscribers. I mean, it was very interesting to see almost 7.66 million plus when the estimate was only 4.5 million. So whatever they did last quarter, they should even do this quarter or even better to attract more subscribers.
Now, of course, we'll keep watching what happens with the ad tier. They didn't give us subscriber numbers from the ad tier, of course. It just gave us the kind of overall change. That was at least a beat. I mean, that's why we got the spike in the first place, right? And so, at least from that expectation, that's what gave us the pop. Now, what's going to give us the continued drive will be to look deeper inside, right? Deeper inside if this is really going to be kind of the way for them, the profitability. They're trying to move forward and they're trying to move forward with profitability and the step back in the EPS. There's something important there. We're going to talk about that in a few minutes when we get into what is holding Netflix back. I did catch some concern there that all investors should be catching. Now let's keep going with the growth drivers. Let's talk a little bit more about top shows and top movies. Why is this a growth driver, right? Well, I mean, just think about it, right? I got the statistics. I was looking into how many nomination, right, from like big awards, right? It seems like you're seeing Netflix, winning Emmys here, Oscars over there. And that's something that never really happened before, right? I mean, no one expected when Netflix first started, when they were a mail service, right? Coming to your house, giving you the DVDs, right? And, even some would break in the mail and you kind of blame the mailman and they'd give you another one. Well, no one would ever have thought that they were going to make not only originals, but then be able to win awards away from Hollywood. I don't think anyone really expected that. And I think that this is the surprising outlook, right? In 2022, Netflix was nominated for 105 Emmy Awards. It's not bad. They won 26 trophies. And this marked, of course, a decrease from last year when it even did more. 129 awards and won 44 Emmys. That just goes to show you how much it's expanded on its original content. It had top shows this year with season 4 of Stranger Things. I don't know if you're a Stranger Things kind of guy, Nick. Have you ever seen an episode of Stranger Things?
No, and everybody talks about it, and I'm like, can you fill me in? What is Stranger Things? They're like, you don't watch Stranger Things. Oh, the amount of backlash that I get because I don't watch movies. If anybody out there on YouTube is watching, I just said it. I'm not a movies kind of person. I don't get into movies. Maybe that's with my day and age. I'm not sure, but no, Stranger Things. Everybody talks about it. I'm like, what is Stranger Things? I do not know what that is, but it's interesting because once somebody finds an episode and once somebody finds a series, they continue and then they want more. And then, then you get well, we're going to discontinue this series and we're going to move to another. And I think that's also conflicting with a lot of people because they're like zoned into one big episode, one big series. And then once they hear it's ending, well, then that's like they're getting their hopes up. Yeah, it's not on Netflix or Netflix is discontinuing it. I only got Netflix for that reason, and then they cancel their plan. So it's going to be interesting to see what new movies come in, what new episodes and shows do come to Netflix, and how many series. How long is a series going to continue for? Is it going to be more than what everybody expects, or is it just going to be that short-lived series saying, okay, not many people are watching, we're done? But what are the people going to do that are watching? Like, where do they go from there? Do they go to another streaming service? Do they cancel? Like, how does all that go around?
One thing that you notice is that there's other titles in here that are interesting, right? Like Bridgerton, right? That's a very different audience member than that's probably watching Stranger Things. And then if you look at a different show like Ozark, season 4, right? That came out, still had it spent 8 weeks in the global top 10. It's crazy how many global top 10s Netflix is able to keep up there. And I think they're going to continue to kick it out of the water. One of the things that I've seen Netflix do as of late is pull back a little bit on that content spending, even though we'll talk a little bit about that coming up. Definitely that's significantly higher. Netflix, though, has been picking up streaming rights, right? To like early kind of 2010 hits like Mad Men, The Office, The Walking Dead. You've seen at least The Walking Dead, right, Nick?
No.
Come on, Nick. You're killing me here. Come on.
I know I am. No, everybody talks
Not even The Walking Dead?
No, and there's a lot of people that say, hey, do you want to come over for a movie night? Do you want to go to the movies and watch this? And hey, do you watch this on Netflix? I'm like, what are you talking about? Never even heard of it. Am I like in my own little world here?
Yeah. Yeah, definitely. And Tiny Pie bringing up an interesting fact here. The spinoffs from the successful shows. We've been seeing that actually work, right? It's actually been a thing. And there was even the Wednesday, right? Did you see that one was an interesting one from the Addams Family, kind of their own original. Hey, I'll tell you one thing. The wife has Netflix. She lets me know all about these, Nick. She watches them all, especially Bridgerton. She ain't missing an episode. But I'll tell you right now, that's one thing that I noticed that Netflix has a tendency of doing. It has a wide range of viewers, right? It even hits some sports fans, at least Formula One fans out there. They love that drive to survive, right? I love watching the stories that they put up there on Netflix. And I think they're going to be moving into more and more of those opportunities with those deeper stories. Shannon said she saw Wednesday. I'm telling you, they love it out there. They definitely love these growth drivers. And I really do think that top shows can really keep Netflix growing. Because if there's anything that's going to keep pushing is having the top content. We all know content is king, right? You hear that statement all the time. I think content is king. That's what we need to keep in mind. They've been killing it out of the water. There's a tennis version of Drive to Survive. Yeah, I even heard they're going to be doing like golf versions. There's so much out there that are just going off just that Drive to Survive. So we'll see what happens there with the top shows and Netflix growth drivers. All right, let's keep going. Let's get into the next area that I wanted to talk about, which would be more along what is holding Netflix back, right? What's holding Netflix back? What is it, right? Well, let's talk about it. And you guys in the chat, I definitely want to hear about the first one here. Who is password sharing? Don't tell us, but definitely you know it out there. There's there's so much password sharing going on. It happens all the time. I remember I used to password share, back when I had my family, but now I have my own account, but it's not like that bad. But I think this is where they need to make some type of change. They need to figure a way to fix this. I know that a lot of places are able to kind of figure this out if there's multiple users on an account. They just need to kind of limit the amount of users that can log in, I think, at one time, right? I think that's probably going to be the only way. I'm not trying to help them out too much because I know how it is. It's tough times right now. But I don't think password sharing in this environment and tough inflationary environment, nah, man. If anything, there's probably more password sharing going on. What do you think, Nick?
It comes to a difference because for the college students, I'll be going to college in a year and a half, 2 years, and maybe I'll get into Netflix by then, but I don't want to pay for my own account. So I'm going to ask my family, hey, can I have your Netflix username and password and can I share it? And like, can you share it? So it is going to be interesting how the Netflix sharing password like happens. Are you going to get like a text message or an email saying, hey, your password has been shared or you're being recognized from a different login? Like, are you going to have to approve something? We need some more information on how this password sharing crackdown is going to happen and basically how it is going to work. It's just it's not very clear how it's going to work. And not only that, but is it going to impact, can you have more on device? Can you have Netflix open on 2 laptops, a PlayStation, a TV, a smartphone? Like, is there going to be a limit on maybe how many devices your Netflix account can be on? And so if you're already on your max, will you have to pay for more? Or if your child in college wants to have Netflix, are you going to have to remove a device and add him? There's just a lot of looming questions that still need to be answered that I don't think Netflix has answers to yet, or they do not. They have not shared them with us and investors just yet.
Yeah, I think it's really hard to see them kind of stop this. They've tried. They've talked about this since 2019 about the password sharing. What year is it? It's 23, my brother. It's been some time. You'd think if they're going to figure it out, they would have already done it by now, right? I just think at the end of the day, it doesn't really matter to them. And I know they talk about it, but we'll see if they mention it in this earnings call. A couple other things, right? And that's holding Netflix back. One, caught on this earnings. Nick, you want to know what hit that EPS? Why that EPS was so low?
I was going to say they said too with growth. It's very interesting for their forecast. A lot of it has to do with the FX neutral basis. They even in their forecast.
There you go.
Yeah, I was going to say, even in their forecast, they say Q1 23 revenue growth of 4%, 8% on an FX neutral basis. We expect our FX neutral revenue growth to be driven by a combination of year-over-year growth and average paid memberships in ARM. This translates into modest positive paid net adds in Q1 23 versus paid net adds of negative 0.2. So that would be roughly, I think, 200,000 in Q1 22. So a lot of it has to do with the FX. And they even say in 21 that the year-over-year decline was due to the appreciation of the US dollar. For the full year of 22, our operating margin amounted to 18% versus 21% in full year 21.
Now, one thing you clearly saw there, Forex concerns, right? There was a huge amount of what? Euro-denominated debt. That's what came after them. We've seen the euro kind of take a big hit, right? Strong dollar is affecting Netflix. They've talked about Forex concerns in the last earnings, and here you're seeing it. That's why it affected their EPS there. Definitely took a big hit there. I was wondering, because the estimates to be that off had to be something that probably the analysts missed. Probably they missed that euro-denominated debt and how that was going to play a factor here. Bigger a factor than I think many played into it. That's why you're seeing the EPS down so much. But of course, there's other concerns, right? With content spend, right? They seem to be spending a lot with movies. I don't know if you saw Gray Man. Gray Man out there team definitely was a popular title. I saw it. I didn't think it was the best movie. We won't get into that, but I know that on the last earnings call, they were super excited about that kind of hitting the tape, right? And we also saw a Netflix kind of movie go into an AMC for the weekend, right? You've been seeing them go into the actual movie theaters. Is this the move that's going to get Netflix in there? Well, content spending is very dangerous, right? You can only spend so much before it gets to the point where now, if they're going to be focused on profitability, can they really be pushing the gas pedal on the content spend? I think if anything, you're going to start to see content spend go down as they try to do their best picking up licenses for those other shows like we talked about, right? Those like kind of like, let's say Friends or something like that. Of course, Friends is on HBO, but The Office, things like that. Old stuff. They're going to be trying to bring it back, trying to keep you on there. Those are cheaper than making originals, right? Making movies. This is what we're going to be watching in their content spending. Another area that we need to kind of keep watch that is important is the competition, right? Streaming wars. What is going to happen there? We've been seeing Disney continue to grow. Disney Plus has been truly become a competitor to Netflix for a long time. A lot of people thought that, Disney would grow, but not that fast. And I think even Netflix is realizing that there's some strong competition out there. We saw Discovery team up with HBO, right? What's going to happen there? Are they going to come out with a combined package? One thing that I've been seeing, I have the HBO Max. I've been seeing all that Discovery content slowly work its way on HBO Max. That gives me a little bit of a hint that they're testing there to see how their audience is reacting. And there's some true competition, right? There's Paramount. I'm not the biggest fan of that Paramount. I don't know about you, Nick. I don't see anything there that I'd be watching. Have you ever thought about Paramount?
We don't even have Paramount because, again, I don't watch. I mean, we have Netflix, but we don't have Paramount. The problem is for Comcast, at least for Xfinity, whenever they try to drive you into these streaming packages, there's so many individual, and it's, do you want to pay the most for every subscription service, or do you want to like pay the least? Do you want to pay the $4.99, $3.99, $8.99? And it's how many do you want already on top of your bill, depending on how many packages you have, what the amount of the packages you are. So it's going to be very interesting to see how many. I would like a survey conducted, to be honest. How many streaming services does one family have? Does the modern average family have? Do they have all of them? Like, do they have Netflix? How do you go about saying, let me pick and choose which one? Because for you people, for the people that watch a lot of shows, what is amounting to them to pick so many different streaming services instead of going to one? Or can you just find them on YouTube or Apple TV? I mean, are these other streaming services like Apple TV, Google TV, Roku, are they going to somehow intertwine or get some kind of a deal so you don't have to buy each an individual package? Are you going to be able to buy like a combined package of all? That would be very interesting to see how that plays out.
Then, of course, let's get into what they're doing well, right? There's competition in the streaming wars, but what are they doing well? Let's talk about that, right? I think that's also important. We talked about what could be holding them back, but what is Netflix doing well? Well, let's just keep it simple, right? They're doing well in international growth. That's continuing. I have been seeing more and more kind of different languages brought on Netflix. I sometimes catch myself, I'm like, hold on. Is this an English movie? Is this a French movie? Is this a Spanish movie? Because you sometimes even get fooled with the thumbnails. You're like, man, all right. So I put it on, and then I'm like, oh, voiceover. This one was a French one that they brought to English. I actually enjoy watching those from time to time, but I can tell you right now, that is helping them keep growing, right? Growing international. They've expanded, right? They're in over it's an insane amount of countries. I have the stat here. It's over 190 countries, Nick. 190, right? I mean, globally, the expansion there is what I think could keep them going, right? If they can keep growing internationally, if they can keep making content for that media, for that traffic, right? That can keep them pushing forward. I don't know about you guys out there, but I have been seeing how they've been growing in Spanish content, and they're doing pretty well. They have some of the top shows now on Netflix from Spanish, and that's going to help them, right? It gives more expansion, maybe even to South America to keep growing. We'll see what happens there. Also, what are they doing well on overall is just the subscriber growth overall. I mean, at the end of the day, they've been the leaders for so long, right? I mean, how long has Netflix been growing and at this game, right? I know Disney just got in this game. A lot of these streaming services just got in this game. There's a reason why we saw Discovery and HBO struggle so much, right? You guys see Warner Brothers there, right? I mean, all we got to do is scroll back on the daily chart, right? I mean, we won't get into that whole conversation about that spike, but it's like that, right? And I mean, when you think about it, from where HBO Max came out a little bit into this pop, and where we are at now, I mean, we've gone down in value, right? And I think those are all things that we need to keep in mind, that some streaming services are going to struggle growing like Netflix did at the start, but they have the advantage. They have the data behind their movies. They have their data behind their content. They know what we like to watch. And I think that that's why Netflix continues to stay in the lead and will probably continue. I mean, do you see any other streaming service, Nick, catching up to the size of a Netflix?
No, I don't. And I think if they do, it is going to be very, very tricky to try and catch up to what a Netflix has produced. Now, I do get, like, if you have Xfinity, you get not Paramount Plus, Peacock. And I'm not exactly sure how Peacock is compared to Netflix, like what the difference is, because again, I'm not a very, very person that streams, but I think it's going to be hard for a lot of these streaming networks to catch up to Netflix. And if they do, they're going to have to spend lots of money compared to what Netflix produces to see. But even going on in general, how is Netflix going to do in a recession era? I mean, we're still having that debate on Wall Street today is how are these stocks and individual companies going to manage if we are in a recession? Are we in a recession or not? And like, how far is Netflix going to do? Are they going to have to do cost-cutting events like all these other companies, lay off workers? Like these shows and the movies not coming to Netflix, they're going to be delayed. There's a lot of questions too that I think may be answered on the conference call tonight at 6 p.m.
Yeah, one thing that I think we should do is I do have some really good statistics. I'm going to go ahead and let you guys know, like whenever I see information around, I like to share, right? I mean, that's what it's all about. Sharing information is how we keep growing here. So we'll let you guys know about this true list. I'll go ahead and I'll even put it up in the chat here if you guys want to check it out. I'm going to bring it up so that we roll through some of this to take a look at some of the statistics that they did here. And I think it's important. It's all about Netflix. This was updated on the 9th of January, so it doesn't have this earnings, but let's go ahead. Let's take a look at it here. And of course, the first thing that they give us, of course, is all about subscriber growth. You can see how overall they've just been growing and growing and growing. And I think that this is what gives them an advantage over others, because at the end of the day, they're going to run into some growth issues while Netflix has already gone through the experience of the growth and has realized that the market is getting more saturated and focusing on profitability. Then, of course, we talked about how the top shows, those are definitely important. It says that Netflix has produced 9 out of the 10 top most popular original series. The only one other here that we could kind of catch is Disney's Plus Mandalorian, right? That was a really good show there. I don't know if you guys saw that one, but other than that, pretty much Netflix taking the top. Then Netflix surpassed YouTube as the most watched service in 2018 with an average viewing time of 23.2 minutes daily. If it can compete with a YouTube, I mean, that says it all, right? I mean, look where we're at right now, right? Look what you're watching. Well, guess what? There's someone else watching just as much, probably on Netflix. So that's something always to keep in mind. I always like finding statistics like this. And then you can see the US adult spending average Netflix time has just increased, right? That's probably doing with their content and how it's gotten better, not worse. Of course, we talk about how the password sharing goes on. It says that 47%, 47.5% don't share their account password. And I tend to think that that's a little bit on the light side there. Of course, 70% of the Netflix is streamed on a TV. Of course, there's plenty of devices to get Netflix from. You got your tablet, your mobile, your laptop, your TV. I can tell you right now, I am actually part of some of this minority, and I actually watch it on my tablet. So I'm on the 5% there sometimes, but that's just because I have a newer iPad, right? Mandalorian theme, true. Yeah, Mandalorian was a good one. That's what matters. The streamer that wins will be whoever holds on to Pedro Pascal the longest. This guy, Tanner. All right, we'll see what else is going on here. Netflix is available 190 countries. We've talked about that. We'll see what else is going on. I think this was also interesting. I talked to Nick before we started, team, and I asked him, well, Nick, do you watch Netflix? Of course, you guys probably already heard from some of his answers a little bit earlier. Nick, what do you watch Netflix?
No.
Why not? Why not? What keeps you away from Netflix? Is it just not the content for you?
I don't know. I think it's a variety of things. Just for my age group too. That statistic you put up, 18 to 24 years, 12%. I don't know. I just have a hard time sitting still and zoning in on one thing for an hour and a half, 2 hours. And I mean, I've only been to, oh, let me see. It's been a while since I've been like in the theaters. And if I was in the theater, I've just got so distracted, looking around, looking up and down, looking who's come, what's going on with the popcorn. I mean, I don't even remember the last time I was in a movie theater. It is very hard for me to just focus on one thing and watch a movie and then like try and explain it to everybody else and like get in on movie conversations. That's just not my type of thing. And I said to Mitch earlier, I don't know if that's a good thing or a bad thing.
That is true. I mean, at the end of the day, I think you look at it here. The age demographic says it all. Looks like it's a little bit older, and I feel like a boomer in here, but definitely it looks like 45 to 54 seems to be the higher use for that Netflix. And what I would say about that is probably they were the people that saw Netflix, grow, right? Grow 10 years, 10, 15 years ago. So Netflix age demographic. Yeah, I think they're going to have to start doing some shorter content for guys like Nick, right? Nick, they're going to have to start coming out with 10-minute shows. So if we start seeing Netflix come out with some short shows like 10 minutes, 15 minutes, that we know they're trying to address some of this 12%, right? The 18 to 24-year-olds. We'll see how that one works out, Nick. It's going to be interesting to see if they can start capturing the age demographics. We've been seeing, I mean, we all know the age of TikTok, right? Short form content has started to be kind of what's being watched more. Can Netflix somehow go into short form content? That could be something to think about, right? They can somehow bring in some shorter shows for the younger demographic. Maybe that can really keep going. Now, I thought this one was really interesting is that Netflix shows stats that about 52% of the platform's subscribers are female. Did you know that one, Nick?
I did not. That was very interesting. 52% of the platforms are female. Wow. Okay. Didn't see that statistic coming.
Yeah, and the big part of this is understanding that they may be trying to address that, right? The gender demographics, right? Seems like they do have a pretty split, right? 48-52. Doesn't seem too bad. And of course, these statistics could be a little bit older. Just want to state that this is from True List. It looks like they got this from Morning Consult. That was the source. But it also states that how CBS, All Access, CBS, right? And it's part of that Paramount kind of life. And it says 62% of male users opposed to 35%. Similarly with Discovery Plus and HBO Max, unbalanced audience, more towards the male user. Maybe that's what's giving Netflix a little bit of an advantage. giving more of an equal balance here for their content. But all right, that's going to do it for our Netflix talk. We talked about why Netflix is doing well, Netflix growth drivers, what is holding back Netflix. And now I'm going to go ahead and take a seat back here and give Nick Brown the opportunity here to have a great interview. We got Michael Pachter in the back, equity analyst for Wedbush Securities. I'll be right here in the back, Nick, if you need me. Let's go ahead and bring on our guest today. Let's do it, team.
Michael Pachter, equity analyst for Wedbush Securities. Thanks for joining us.
Of course, Nick. Thanks for having me.
What is your initial reaction on the earnings? I was reading through your note that you sent me, and you guys you nailed it. I mean, you raised the target before the hit, and look, stock is going up.
Let me address two things Mitch said, because I think I don't want to leave your viewers with the wrong impression. There was a short form content company called Quibi bankrupt, so that's a bad idea, and Netflix isn't going to do it. And then the demographics, 52% women. I can tell you confidently that more men watch televised sports than women. And so if you suck up all your viewing time watching sports, you're not watching as much Netflix. And if you don't watch sports, you're watching more Netflix. So women who don't watch sports are more likely to watch Netflix. Men who do watch sports are less likely. That's why the 52-48. As far as the subscriber number, and it was much better than I thought. It was a little worse than I thought in the US, much better than I thought everywhere else. The big tell in the earnings numbers was the average revenue per user, which was down sequentially in every region. And that's a big deal, because if you're trading down, and I hate to use that term, but if you're adding subscribers at $6.99 instead of $15.49, then your average revenue per user is going to go down. And that's exactly what we saw everywhere. So that's telling me that the ad-supported service, the tier, is super popular. They picked up people everywhere. And they made two comments in there. One was that they had excellent retention. I've never seen them say that before. So that means that people who tried to quit were talked out of it by being cross-sold the ad-supported tier. And then the second was that they don't expect to lose any revenue from the ad-supported tier. They think they'll make up the lower subscription price with ad revenue. They didn't report that, and we saw a lower ad ARPU everywhere. I'm sorry, average ARPU everywhere. So it's telling me they aren't there yet, that you're gonna see that tick back up as they sell more ads, but they did stumble out of the gate. We saw early on that they had trouble delivering as many ads as they had committed to advertisers.
What do you think of the password sharing? I mean, they're trying to crack down on everybody trying to share the password. I mean, how do you think that's going to impact them?
You're going to be there pretty soon. My kids are just a tad older than you. I've got two college seniors. It really depends on how they do it. So my kids are college seniors and live at college, so they don't live at home, and they use my password. And I'm acknowledging that now. Netflix, come after me. I am not a thief. I'm supporting them. I feel like they're part of my family. They use Netflix when they're home, and they use it in their apartments. But I have to say, the day they graduate and they get jobs and they're on their own, I would expect them to get their own subscription. And if Netflix says to me, hey, wait a minute, we'll help you out. Here's a new plan, add 2 more family members and pay us $5 a month more or something, I would totally do it. That'd be a better deal for me. It's honest, and it's something that I actually want to do. So I expect that what you'll see, and they're going to announce that this year, probably the next 3 months, you're going to see ARPU go up as people adopt that. And that's a really good thing.
I really thought in your note too, when you said we think Netflix is poised for significant free cash flow growth in the coming years. I really do think that's possible now after this earnings report, even though they missed on some guidance. But I think what they reported today, it was just out of the park. Nobody expected it besides Wedbush.
They flat out said that they expect to generate more than $3 billion in free cash flow this year. And in 22, they generated $1.5 billion. So clearly it's going in the right direction. They've taken a lot of steps to manage costs, and we're seeing that. They're especially on the content side. they're making about half as many movies as they made last year, so that's good. They're trying to shift a lot of television production to low-cost places like Korea, which have great production values and great content. And people, we saw Squid Game. People like that kind of content. So I think it's really smart to to produce content that's got global appeal in inexpensive jurisdictions. And that's how you generate free cash flow. That's what makes a stock worth a lot more.
Do you think that you currently have a $400 price target on the stock from 325? Do you think Netflix could go above 400? Do you see Netflix going above 500, 600, returning to where it was during the pandemic?
I'm pretty famous for having a sell rating on Netflix from call it $10 to $6.90. So I only missed $680 of price appreciation. I rode that sell down to 180 or 190, and then I upgraded to buy. I'll stick with one target at a time. I think it gets 400. Come back and ask me what I think when we see the metrics that support $400. And if I think they support 500, I'll go higher. But I don't know what's going to happen. If it hits my price target, I have to decide what to do at that time, and I'll decide when it gets there.
Do you think Netflix is poised? What do you think Netflix is going to be poised for a recession? How do you think Netflix is going to perform during a recession? Do you think they're going to be laying off workers like everywhere else? Or how do you think Netflix is going to do in an environment recession or in the recession environment?
It's kind of fascinating to me that during the election, all we heard about was recession and inflation. And since the Republicans took control of the House, they've dropped those two words from their vocabulary. And instead, it's Hunter Biden and weaponization of federal government. I'm not so sure we're going to go into recession, but if we do, it's probably going to be because the Republicans refuse to raise the debt limit, and that'll cause lots of bad ripples through the economy. If we have bad ripples, the worst thing that could happen is that people lose jobs. And if they lose jobs, it's an open question whether they keep Netflix or they're more likely to join Netflix. I think people who are stuck at home with nothing to do are more likely to entertain themselves. And, we don't have a lot of history of Netflix streaming because we haven't had recessions since they started streaming. But realistically, video games thrive, movies thrive in recessions. So my expectation is Netflix streaming thrives if we, in fact, have a recession.
And do you really think Netflix is going to be the top streaming performer? Could Apple TV, Disney Plus, could all the other streaming services top Netflix? We were having this conversation before you joined in saying, do you think any of these other companies will be the Netflix, or do you think Netflix is going to be Netflix and is going to be the number one?
I think that there's room for multiple participants, but I think that it's not like, Netflix is McDonald's and Disney is Burger King. It's more like Netflix is McDonald's and Disney is Ruth's Chris Steakhouse. It's a different business because they have much less content and much higher quality content. And so I think the guys who are differentiated on the basis of quality, like HBO, will thrive. So Disney, HBO, Netflix thrive. Hulu maybe because it's got a lot of Disney content, but I don't see Peacock and Paramount Plus thriving. I think those guys are going to struggle. So everybody doesn't win. I do think the big loser is retransmission companies. It's the MVPNs, the cable companies. We're not going to pay as much for cable. We're going to strip down to basic cable, or we're going to go to rabbit ears, and we're going to take that money and subscribe to multiple services. So ultimately, I think the streamers thrive. The big three, Disney, HBO, Netflix, thrive. It's an open question whether the other guys will be good or not.
What are you hoping to hear from Netflix on the conference call that kicks off here in about 8 minutes?
A whole bunch of nothing. They never answer any questions. They toot their own horn. They bring in a friendly suck-up analyst to ask softball questions. I do hope that they give us some clarity on ad revenue. I don't think they'll give us a number, but I hope that over time, if it becomes a big number, if they end up with 20 million or 30 million ad-supported households, I'd like to know if they're generating $10 or $2 a month. So I think they kind of have to tell us that. And I'd just like to hear that. And I'd also like to hear Reed Hastings tell us what his plans are. Is he stepping up to executive chairman and he's going to continue to work, or is he stepping aside and just gave himself a title? I don't know.
I do have to ask you, Michael, what do you think of the Forex, what we're seeing with the Forex headwinds, with a lot of these companies saying, hey, we're not going to be able to meet expectations because of FX. How do you think Netflix is doing in this environment?
Well, Congress can mess that up right away by defaulting on our debt. And you watch what happens to the dollar if nobody wants to invest in the U.S. anymore. So I think the dollar's strong for a whole variety of reasons, but that's going to be a headwind as long as the dollar's strong. It's not in our country's best interest to keep the dollar strong because we don't export, which has nothing to do with Netflix. But it's hard. It's bad on business, and the dollar's strong because we have full employment, and people are actually feeling pretty good. My expectation is that this drawn out congressional standoff over raising the debt ceiling is going to screw things up for a few months, and the dollar probably pulls in a little bit, and we don't hear anything from companies about it anymore.
I do have to ask really quickly, probably the last question, so I can let you go and prepare so you can be on the conference call. Do you think that Netflix is going to be more worldwide? A lot of more people from Europe and from worldwide, just inside of the U.S. What are they going to have to do to try and attract more viewers from outside the United States?
Well, they're really big. If you look at their numbers, they have 74 million in U.S. and Canada. They have 76 million in Europe, Middle East, Africa. So, they've already managed to get there. And if you add up Latin America and Asia Pacific, they've got 79 million. So they're really pretty balanced right now. I think that, the question is, are they going to try to continue to grow in low revenue countries like India, where I don't see how there's a path to profitability? And will they subsidize growth in a place like India from profits in the U.S.? I'm hopeful that that they continue to focus on developed countries and not in developing nations, that they're just not going to be able to charge more than $4 or $5 a month in India when cable TV costs $4 a month. It's hard to do that. So again, Japan, Korea, absolutely, they'll keep growing.
Michael Pachter of Wedbush, thanks for joining us.
Of course, Nick, thank you.
Hope we can get you can come back soon whenever they report again, and would love to get your thoughts. Thanks
I'll
again
come
for
back
joining
at 400.
us.
I'll come back at 400 and defend it.
Oh, perfect. That works. Thanks, Michael.
All right, Nick. Thank you.
Alrighty, that was Michael Pachter, Wedbush Securities. Mitch, I don't know. What do you think of that?
I enjoyed that. I had to even put myself on mute. I was back here talking to myself, but definitely enjoyed that. And good comments there by Michael. Always. What I loved about Michael is, like he said, right? He's the type of person that he saw it all the way as a sell into a certain spot and was able to be flexible on the story. Now seeing the turnaround. And I mean, we're not too far from that 400. I remember when we were first coming up with kind of levels when Netflix was down here on that big drop. Of course, we had that on pre-market prep, and we saw that big drop. We were wondering, would Netflix climb that wall right back? And I mean, we've been seeing it. And one of the things that I think Netflix is definitely, it's best of breed. Let's just be honest. They're still best of breed. They should stay best of breed. And I continue to see Netflix growing overall. They're just finding ways to keep getting the lift back. Now the only question is this a little bit, where are they going to get to? Like, is this going to be like the 50% retracement? Because that would put us back closer towards 426. We'll see what happens there in Netflix. But of course, their earnings call is going to be starting in just about 4 minutes. I'll get you guys over as soon as I see that come up. But we're going to be wrapping up shortly here. Nick, what you think about your interview?
First interview, and I thought I did pretty well. Any comments from you, Mitch? Any comments from the chat? I'd like to hear the feedback.
Well, I mean, I thought you did pretty well there. You brought in some good questions, like always. We get better, right? What I always say is 2% better every single day. I remember when I first started doing interviews, I used to literally be a little sweaty, a little antsy. I saw you. That's what it's all about, man. And I enjoyed that you got Michael Pachter, one of the best out there, definitely covering Netflix. And I like I've mentioned it, he went from a sell to a buy. that's probably the person that you want to be hearing from, right? There's very rare cases where that happens. That'd be like Gordon Johnson turning around on us and telling us that he's going to go on a buy on Tesla, right? I'd be definitely paying attention what happened if that would happen. Let's go ahead. Let's take a look at the recent price action. It looks like Netflix has just been slowly climbing. I talked about when we first got here, Nick, would we get to the 340s? Look how we get close to that. Like it's just a slow little get up there. Well, it got up there towards 339.30s. I don't see too much higher than that. We'll see if we get past the 340s. Of course, the high on the day towards 345.64, and that's in the after hours. We'll look to see what happens with Netflix. And overall, did it affect the SPY? How's the SPY doing right now? Slowly climbing. Slowly, we're getting a little climb. We'll see what happens there in Netflix. Of course, the earnings call will be starting up in just about 2 minutes. Should be able to get the video up in just about a minute or two. They're usually right on when they put the video out. So I'll get you guys that as soon as it's up here. And we'll keep watch to see if Netflix can continue growing. Of course, subscribers coming in a little bit better on that paid net change. We wish we would have got what exactly happened there for the ad tier. But in 2 minutes, we'll find out. Maybe we get a little bit more from the earnings call. You guys stick around. Check out the earnings call. That's going to come up next. And we'll see if we have a little bit more of some Nick Brown covering some earnings. Hope you guys enjoyed Nick taking his shots today. I want to say thank you to Nick because he set this all up. He was the leader, really. I just came to be a part of the show. So I wanted to say thanks, Nick. Keep trying, my friend. Keep working your way into the industry. I've seen you from the very start, I think. Very early, working towards added. And you've gotten better. That is 100, my friend. And as you keep growing, we'll definitely have more opportunities for you right here on Benzinga. Smash the thumbs up for Nick today, guys, coming in with here. Also getting us a Wedbush analyst to have a great interview. Thank you, Nick. And with that being mentioned, 5:59. There's 6 o'clock. We should be starting up in any second here, getting you guys over to the Netflix call. I'll let you go ahead and say farewell, Nick, and I will be getting us that call in just any second here.
No, thank you guys. Thanks, Mitch, for doing this. I think as you said, practice makes perfect, and this is what I'm gonna have. This is what I want to do when I'm older. So it's just you got to start small, and you'll somehow end big, and you just got to keep working at it. But I know, thanks. I really do appreciate you, Mitch, for taking the time out of your day, staying a little after, helping me out, making sure, I was a little nervous there, but no, I think Michael is a great analyst. He just goes with the flow. He gives you the answers. And, Michael, I hope you're probably still listening, but I hope that you'll come back on. I can interview more. But thank you, everybody. Thank you, Mitch. And to the conference call we go.
All right, team. I'm going to go ahead and bring us to that conference call here. Like always, team, we'll stay in the background. You guys can keep chatting with us there, and I'll see you guys there. All right, let's get this on the screen.
CFO
Boom,
Spencer.
boom. Let's get it
Our
started.
interviewer this quarter is Jessica Reif-Ehrlich from Bank of America.
All right, Nick, I'll get
As
you
a
out of
reminder,
here.
we'll be
Appreciate
making
you, my friend.
forward-looking statements and actual results may vary. With that, Jessica, over to you for your first question.
Thank you, and thank you so much for having me today. So, Reed, the big announcement about the management changes. Could you give us some more color on the process and how you came to this decision?
Jessica, it feels like yesterday was our IPO. We were covered in red envelopes. We IPO'd at about $1. Hopefully some of you have held the stock the full 21 years. And when I think of the evolution, the three of us and so many other incredible Netflix employees, to go from DVD service to streaming leader in films and television, an emerging player in games, and now to have over 230 million members. It's just, Jim Collins probably said it best. He calls it a good start. We've had a good start. But, honestly, we dream of the whole world finding their favorite entertainment on Netflix. And we shorthand that as entertain the world. And the three of us have been working together for 15 years now, trying to figure out how do we get through this issue, that issue, how do we grow? And I couldn't be happier to complete our succession process. It really started about 10 years ago with the board, trying to think through how could this work. They both have such amazing talents and gifts, and to find a platform where they've been able to contribute is fantastic. About 2.5 years ago, we took a partial step. Ted as co-CEO, Greg as COO. We continue to just make super progress, and frankly, more and more they've been leading the company. And this is acknowledging really in formal terms how we've been operating, for at least the last few quarters. It's just a great feeling. And when I think about the stock appreciation over the last decade, I know that they want to beat that record. And I'm all for that. I'll be executive chairman, helping them everywhere I can. But it's really theirs to lead and to do that energy and hustle and intensity that we've been doing. They're very ready. That's what's driving the timing. And so I could not be happier. So back over to you.
Thank you. Subjectively, I'll just add that this may be the smoothest transition we've seen in media for quite a while. Now, for Ted and Greg, what does this mean for Netflix? Does this signal a change in strategy or approach?
Jessica, let me start with first and foremost to thank Reed personally and professionally. He has been, and I trust will continue to be, a role model, a mentor, a friend. In 22 plus years, Reed has positively changed my life in every way imaginable. And he leaves some big shoes for Greg and I to fill. Unfortunately, we have 4 feet to do it with, so that's a good thing. In so many ways, the way that Reed's been able to see around corners, that's why he's been thinking about this succession for the last decade. He generously opened up more of a co-leadership model over a decade ago for he and I, and like he said, 2.5 years ago, made it a little more formal. And in that time, delegating a lot of the day-to-day to Greg and I. And in that time, in the 2.5 years we've been working together for 15 years, Greg and I. But in the last 2.5 years, particularly, we've been able to build a really trusting, respectful, and complementary partnership. In many ways, the same way I have with Reed over the years. And I really do believe that this kind of shared leadership model is going to help us to move fast and to challenge each other, to challenge the company, to raise to new heights. And I'm just incredible what we're able to do. And to your point, this is the leadership team. It's been pretty stable, and that's why this steady transition feels so steady. The stability of this team has helped us build a great foundation and a culture that can absorb complexity and change. And as you saw in this last quarter, can rise to any occasion. And Greg, I just want to say I'm thrilled to be in this with you. And Reed, we can't thank you enough.
Thanks, Ted. It's a real honor to be asked to take on this responsibility and join you as co-CEO, and frankly, a pleasure to be able to continue working with some of the most amazing leaders that I've ever had the pleasure of working with, and frankly, in my opinion, the best leadership team that Netflix has ever had. So I'll just echo Ted's comments. It's been a real fun and rewarding experience to work closely with him over the last couple years especially, and I'm tremendously proud of the partnership that we've developed and the shorthand and really how we have been able to take what are sort of a complementary set of skills and perspectives and seeing different angles to different situations, but basically at the end of the day, I've always found are ultimately motivated by the same things, which is that we want to serve our members and we want to grow our business, and that is an incredible and powerful aligning process to those different perspectives. So I'm proud of the work that we've done over 22 in the latter half, especially to get some more momentum into the business. But I'm even more excited about continuing to push that into 23 and follow, the model that Reed has always had of, continually seeking excellence and always striving to be better. So looking forward to that. And then to your specific question, Jessica, there's no big strategy shift or big culture shifts. Ted, Reed, and I have been working and sort of grinding through our individual perspectives on this for a long time. And so really we look forward to, taking things forward as we have been for the last little bit and responding to a dynamic industry and doing the changes that we think are appropriate, but we don't have a bank of changes that we've been holding for this moment. So mostly it's continuity and move forward.
Great. So this was originally for Reed, but now given the change in leadership structure, maybe for all 3 of you, for Reed, Ted, and Greg, one of the best quotes recently was from John Malone, who said shareholders should build a monument for Reed Hastings. John and Rupert Murdoch ran the dominant global media companies in prior decades, and we're one of the few media executives who've been able to see around corners. Ultimately, they both sold the bulk of their assets. Netflix is now one of the most dominant global media companies, if not the dominant. What is your view of the next 5+ years? Do you need to get bigger, stay the course?
Well, the one thing I'd point out is that what's happening now and what's going to be happening over the next couple of years is that the consumer is moving to streaming. So the way that they watch content at home, delivered to them on internet, on demand, free of the linear schedule and all those things, that is a change, a fundamental shift in the business. And you've got to be where the consumer is. And that's what we've been focused on since we started streaming, doing original content 10 years ago. But being really realizing that we really have benefited from being a customer first company and meeting the customers where they are. And we've also had this blessing of not having to unwind our traditional media business as we built into this one. So we've always been focused on the future and where the consumers are going. And I think our ability to continue to stay focused on that, because this is really, I know we've been talking about it for a long time, Jessica, but this is really in its infancy. I mean, you think about as big as we've become and all these things that are happening, and in the US, we're about 8% of TV time still. So it's an enormous amount of growth ahead, even in markets where we are very well established. So that's the key for us, and I think being able to focus on consumers first, and has really been our biggest benefit. And I think it's what led us to those milestones that you just referred to. Greg?
Yeah, and Jessica, I would say, I think that translates into being bigger. And I think that means being bigger in terms of touching more members around the world, delivering them incredible entertainment. We'll see that in terms of being bigger, in terms of the amount of engagement that we can drive, the amount of hours that we're satisfying them. Be bigger in terms of the culture impact is too. I mean, you've seen, just incredible cultural impact in terms of Wednesday, Stranger Things, the ramifications that these shows have in terms of the popular culture are significant, and that's going to get bigger too. It also means bigger in terms of revenue and profit streams. So we're looking forward to those as well.
Right. So losing subs in 2022 and the market reaction or valuation reset is akin to August 2015, when Bob Iger called out the early decline of paid TV subs and the impact for Disney's ESPN. It will take a while for Disney to build ESPN Plus into a sports streaming giant. And actually, they may never replace the profitability of ESPN at that point in time. Your pivot seems more broad-based by extending genres and going to new areas, whether it's games, fitness, live, etc. Do you see any similarities or differences to that momentous inflection point, which has certainly shifted Wall Street's view from subs to profits?
I'll take a shot at that, and then Ted maybe weigh in, but I think it's a fundamentally different situation. And if you look at where we're at, a significant part of what we need to go do is essentially take the core model that we've been operating, since we've been starting in streaming, and just execute it better in all dimensions. And so, whether it's, the incredible content that Bella and Scott's teams are producing constantly, how we're talking about that content through the marketing and conversation that we do, the product experiences and business model innovations that we're doing. But a lot of it really fundamentally is about executing that core model better. We're not, there's not a lot of, massive pivots away from a traditional legacy business model that we have to go figure out. We're planting some seeds, in terms of games and things like that, if we execute well, and we're excited about the progress we're seeing so far, will represent, the future potential for us in terms of growth and more profit opportunities. So that's exciting. But essentially, a lot of this is just, continue to execute the play that we've got and do it better and better.
And then I don't know about the similarities, but I would say that this business is really completely about engagement, profit, and revenue. So we've got to grow all of those things, and all those things are tied to executing on the content. When the content's working, the business is working. We grow engagement, we grow revenue, we grow profit. There's an interesting thing, starting in July, and you think about from Stranger Things season 4, from the phenomena that became, and what we've been able to offer up to our members from that day forward. So they went from Stranger Things to Extraordinary Attorney Woo, which was a phenomenal success throughout Asia and in South Korea, but also built a big cult fan base in the US. Straight into Sea Beast, which is our biggest animated film ever. Straight into Purple Hearts and Gray Men, 2 of our most watched films ever on Netflix. And then to August, to Sandman and Never Have I Ever season 3. September, Cobra Kai season 5. Empress. Cyberpunk is this animated adaptation of a video game that's been hailed as one of the greatest of all time. Narcos Saint, another monster hit from North Korea. The Jeffrey Dahmer story, Monster, straight into Watcher, so back-to-back hits from Ryan Murphy. All Quiet on the Western Front, which just today became the most nominated non-English film in the history of BAFTAs. Only Gandhi has gotten more nominations in the history of the BAFTAs, and that's from Germany with the great Ed Berger. And then straight out of there into Enola Holmes 2, a big monster success sequel to with Billy Bobby Brown. And you look at all these things that go back and forth, and they go all the way into January now. We'll end the month with You People, Eddie Murphy, and Jonah Hill. Any outlet would kill to have any one of those months as their entire year. And it's our ability to fire on those cylinders and create hits. But more than that, create the expectation that as soon as you're done with this one, there's another one waiting for you.
So let's move on to some.
Jessica,
sorry.
may I just one thing to add? I know we went on, but I just think the analogy is kind of fundamentally different. So with ESPN and the example you gave, that was a fundamental kind of shift in the industry from 100+ million pay TV connected homes to cord cutting that's on a path down to mid to high single digit reductions in that distribution platform each year, and that's moving in that direction. So it's kind of a shrinking core distribution platform, where you see in our earnings letter, the world is shifting from linear to streaming. Even in the largest, there is no country where streaming is more than 40% of share of TV time. And in many big countries, as you saw, it's less than 5%. So it's worth less than 5%, it's less than 10%. So there's an incredible runway still in the shift from linear to streaming. And so for us, it's about growing into that shift and also obviously competing well and continuously innovating and improving. And what you saw, or what we saw and felt when we had that decline in subscribers, was really near-term limiters in growing into that big market. But the big market is still growing, as opposed to fundamentally long-term limiters in that ESPN shift that you described.
Right. So let's move on to some of the drivers of growth, both near and medium term, and start with advertising. So your advertising platform's been open only 2 months, and you've amazingly given some money back to advertisers, indicating in one way that demand is exceeding supply. The company is, you guys have consistently said you're going to crawl, walk, and run. How is the crawl stage going relative to your expectations?
Yeah, like you say, it's 2 months, and I think the hardest part is actually that first step when you're crawling, because you don't really know what exactly to expect as you get it going. And now with 2 months, it's ridiculously early, but we've learned a bunch already, I would say. So just ticking through this, I mean, I'd say first and foremost is that we were able to launch this very, very quickly, and the tech is all working, the product experience is good, and that's really testament to lots of hard work from both Microsoft and Netflix teams who worked very hard to make that happen, and it's really rewarding to see. The other, I'd say, pretty significantly fundamental thing is around engagement, and we see that engagement from ads plans users is comparable to sort of similar users on our non-ads plans. So that's really a promising indication. It means we're delivering a solid experience, and it's better than we modeled, and that's a great sort of fundamental starting point for us to work with. Furthermore, now we're seeing take rate and growth on that ads plan is solid. It's great because partly that take rate and that growth is due to incremental subscribers coming into the service because we have a lower price point. That's $6.99 in the US, 4.99 euros in Germany, just to give you 2 examples. And so that elasticity is a real, not only a benefit to sort of growing our ad scale and sustainability, but also to the general business. I expect to see that continue to actually grow over the year. That take rate, fits sort of within the middle of our other plans, which is another really healthy sign. It means that we've got a complementary set of offerings that are working to sort of satisfy different needs for different consumers at the right mix of features and price points. So that's quite good. Another important one, I think, for the investor community, because it came up a lot before we launched, was plan switching. We aren't seeing, as expected, much switching from high ARM subscription plans like premium into our ads plans. So the unit economics remain very good as we modeled. So So these are all, really good initial sort of progress points, but I think it's, important to reiterate that, as you mentioned, we're crawling and we'd like to get to sort of, move to the walking phase. We got a lot to do to get there. So there's a bunch of technical improvements in terms of, ad delivery validation, measurement. We've got progress already on that, more to do in the next quarter or two. Targeting improvements, which will be better for consumers, more relevant advertising, better for advertisers in terms of more, value delivered, a better set of offerings, products for advertisers to buy. We got a long list of experience improvements that we know we can deliver that'll deliver more value to both subscribers and advertisers. And there's just also some nuts and bolts stuff that we are learning and improving. Just, things like how do we, do a better job with Microsoft at the ad sales and operations processes. There's so much that we need to do. Both companies need to do to better serve advertisers, serve an increasing number of advertisers, and meet that demand. So we're just getting started. We're constantly improving, and we see the trajectory ahead of us. And really, our aspirations are, ultimately, successively over a period of years to basically build, just like we have, essentially in terms of the streaming experience, the best, most effective, highest quality, premium connected TV ads experience as a win for consumers and advertisers, and for us as a business.
Right.
Hey, Spence and Greg, sorry, Jessica. Spence and Greg, maybe give a little context on Hulu. Kind of, what we know about Hulu's advertising. They've had a 10-year head start, and sort of, how many years will it take us to sort of pass them in all of these key dynamics?
Greg, you want to go first or you want me?
No, I'll hand it over to you.
All right. Let's see. I mean, Hulu, yes, they've had a long head start. They started in the ads business. They have, we would estimate, Reed, and we obviously don't know exactly, but roughly half of their membership is on the ads tier. It's a multi-billion-dollar business for them already, and that's a domestic business, U.S. only. So lower reach, lower engagement than us. So I guess the short story there is we have, given what we've seen and what Greg just outlined in terms of the engagement on our ad plan, the strength of the performance in terms of the monetization, kind of the unit economics, and our ability to kind of scale in a way that is even better than the kind of comparable ad-free plan, plus providing clearly choice that our members or consumers are seeking out because of the sign-up flow, that we would expect to be as large or larger over time, certainly in just our U.S. market and more from there. But I just want to emphasize, it's a multi-year path. So we're not going to be larger than Hulu in year one, but hopefully over the next several years, we can be at least as large. And we wouldn't be getting into this business, obviously, Reed, if it couldn't be a meaningful portion of our business. So we're over 30 billion of revenue, almost 32 billion of revenue in 2022. And we wouldn't get into a business like this if we didn't believe it could be bigger than at least 10% of our revenue, and hopefully much more over time in that mix as we grow. So that's kind of how I see it without putting a specific guide on it.
You committed to an upfront market spot, taking CBS's prior spot, CBS now Paramount spot, which really indicates your long-term advertising goals of being a major advertising platform. Given this is a prime spot on a critical week for advertisers in premium video, it's amazing how quickly you just took that slot away. What's the run stage, and what's the time frame to get there?
Well, I think as Spence talked about it, it will be an iterative process. To your point, it does signal we have big aspirations here, and we think there's a big potential opportunity. And so, we're committed to incrementally execute against that opportunity. But, I do, just back to Spence's point, we are starting from a zero base essentially. And also, we're also starting from a history where, as a non-ads platform, we had a lot of folks who basically joined Netflix fully as, non-ad subscribers. And so I think, that we'll be working through that over a period of time. But again, our goal and aspiration is that this is a very meaningful and significant source of revenue and profit for us over many years to come.
So, I mean, when you think about the pool of money that you're targeting, linear, let's call it $50-60 billion business seems like the easy money. Viewers, as you've mentioned already, viewers are shifting from streaming, to streaming from linear. We've seen all of the, kind of eyeballs move. And so now you have like, basically more scale and more reach, but the digital pool is much larger. But in the past, you've made comments, the company's made comments that you can't compete with Google and Meta, or it would be incredibly difficult to compete with them. Has this changed? Has your view changed?
Not really. I would say that, initially we're competing mostly with that sort of traditional, TV advertising pool. Now, I think we can layer into that over time components of what has made digital advertising so effective. So you think about the targeting capability, the fact that we're 100% signed in, fully addressable. If you think about the growing relevance of first party data and how we do that, those are real, big advantages that we can bring relative certainly to the traditional TV world. But again, the form that we have, at least, for the next couple of years, will still be in that sort of lean back, primarily in that lean back experience. And so that, lends itself to certain kinds of advertising and certain kinds of advertising goal. And a lot of the demand collection component that, a Google or a Facebook is really good at, we won't be well suited to compete with that for at least some time to come.
And Jessica,
And
just to add to that, the good news, as you saw in the letter, is that branded video ad market that Greg talked about us focusing on is about $180 billion globally, ex China and Russia. So we got plenty to do, and a lot of opportunity ahead just in that area alone.
Yeah, no, it's an enormous opportunity, but there's also, besides advertising, there's an enormous opportunity in incremental subscribers, as you have mentioned. You're the lowest price service, at least now, you're the lowest price service. Can you frame the opportunity in terms of sub growth? How are you thinking about it?
Sure, and just to comment on lowest priced, I mean, again, we don't really think about the pricing question from a competitive perspective. Again, we're think of ourselves as a non-substitutable good. When you think about Wednesday, or you think about Glass Onion, these are titles you could only see on Netflix. That's extremely powerful. Scott and Bella are delivering more incredible titles that are non-substitutable in that regard. So really, we think about the pricing question as how do we offer a wide range of options for a wide range of consumer needs. We want to make that spectrum even wider as we seek to serve more, members around the world and try and deliver, appropriate value at those different price points. And we're doing a good job expanding that range. And so then you think about, so there's two pools then of incremental subscribers. There's a bunch of, people around the world in countries where, we're not deeply penetrated, and we have more opportunity to go attract them. A component of that is we've got folks that are watching Netflix who aren't paying us, as part of basically borrowing somebody else's credentials. And our goal is over this year to basically work through that situation and convert many of those folks to be paid accounts, or to have the account owner pay, for them to get a Netflix subscription. But either way, we're seeking to sort of monetize the viewing value that we're delivering. And then beyond that, it's back to Spence's comment. Even our most penetrated market, we're 8% of total TV time, which is potentially a relatively narrow lens to think about the broad competitive entertainment offering. So we have huge opportunity to grow the engagement component of that several X. We feel like we can get to if we do a great job of executing across all fronts, and that represents a tremendous opportunity for more entertainment value delivered, and we believe that the revenue flows from that in time.
Before we get to password sharing, just one last advertising question. You now have roughly a decade of producing your own IP. Any thoughts on offering a fast service over time, free advertising supported television?
Ted, do you want to take this one?
Yeah, look, we're open to all these different models that are out there right now, but we've got a lot on our plate this year, both with the paid sharing and with our launch of advertising and continuing to this slate of content that we're trying to drive to our members. So we are keeping an eye on that segment for sure.
So on the password sharing, what will drive consumers to pay $3 or $4 for sharing versus becoming a sub with their own profile? Is it affordability? Is there something else? What do you expect?
Yeah, I think there's a range of motivations for different borrowers. So, some of it is economically driven, and so part of what we're trying to do is make sure that we are being responsive to that and finding the right price points, whether in terms of a individual account or an extra member affordance. And obviously, the ad supported plans give us the opportunity to present a lower consumer face pricing in those countries where we have advertising. Part of it's just what we call casual sharing, which is people could pay, but they don't need to, and so they're borrowing somebody's account, and so our job is to give them a little bit of a nudge and to create features that make transitioning to their own account easy and simple. So we have this basically profile export feature, which allows you to take your viewing history and all the great recommendations with you. So, to your point, there's a range of motivations and I think a range of solutions that we'll be able to offer to land people in different places.
Can you provide any details, including the timeframe for converting borrowers to paying accounts?
Yeah, so we've been working hard at this and trying to do some sort of thoughtful experimentation and let our members really speak to us in terms of what set of solutions work for them. So that's the testing that you've seen us do over the last couple of quarters. We feel like we have gotten to a good set of features. It's the profile export that I mentioned, but there's also a bunch of account management features that we think are important to making this experience work for folks. And so we're ready to roll those out later this quarter. We'll stagger that a bit, as we work through sets of countries, but we'll really see that happen over the next couple of quarters. And I think it's worth noting that this will not be a universally popular move. So there will be current members that are unhappy with this move. We'll see a bit of a cancel reaction to that. We think of this as similar to what we see when we raise prices. So we get some increased churn associated with that for a period of time. But then generally what happens is both from the specific changes that we make, we'll see folks come on as new subscribers, essentially borrowers creating their accounts, or incremental monetization through the extra member that'll happen shortly thereafter. And then clearly our job is to continue to grow value, right? To have more amazing titles that people cannot wait to see. And so whether that's satisfying those members, to make those transitions, or winning back essentially folks who have turned off the service and bringing them back onto the service over the months and years to come.
And then
Jessica, sorry, I just maybe just because we touched on it a little bit in the letter, but just to kind of reinforce a little bit of what that looks like in terms of timing and guidance. So those dynamics that Greg just walked through, because of that, as we kind of start to roll this out later in Q1, based on the timing, what we talked about is that we'll have modest growth we expect in paid net ads in Q1, but kind of atypical seasonality, where typically Q2 would be a softer paid net ad quarter. It'll probably be a larger paid net ad quarter, and most importantly, what we're most focused on is obviously revenue. That is our primary metric. And what you see is in the guide, these revenue initiatives between paid sharing, rolling out, and then scaling ads. You don't see much of that in Q1, which is why we're forecasting 8% growth, FX neutral, in Q1 revenue. But throughout the course of the year, we would expect to see accelerating revenue growth as we roll out paid sharing, broadly across our business, and then obviously scale ads throughout the year, which is a more gradual build. So I just want to kind of highlight that, and that's kind of what you're seeing in the guidance.
And given the revenue drivers of paid sharing and advertising, how are you thinking about price increases in the current year? Is it just too complicated? How are you thinking about it?
Well, I would say that the two initiatives that you described represent the bulk of our pricing strategy in 23. We anticipate that they'll both be, revenue positive, revenue accretive, significantly so, in the according to the details that Spence just offered. Now, having said that, our core sort of pricing approach in theory remains the same, and so we're going to look, at the metrics, that our members are giving us and telling us, and look for opportunities where we've I think we've done a good job at creating more value for them. And, for a certain, customer segment in a certain tier in a certain country, we think we've, done a good job at delivering more entertainment for them. And then, we'll go back and, opportunistically ask for them to pay a little bit more so that we can sort of keep this, virtuous cycle going and really invest that back into incredible content and stories. And maybe Ted, I don't know if you want to highlight anything that you see coming on that side.
No, I would just say that, it's the must-see-ness of the content that will make the paid sharing initiative work. That will make the advertising launch work, that will make continuing to grow revenue work. And so it's across film, across television, it's the content that people must see, and that it's on Netflix gives us the ability to do that. I'm super proud of the team and their ability to keep delivering on that, month in and month out and quarter in and quarter out, and continuing to grow in all these different market segments that our consumers really care about. So that to me is core to all these initiatives working, and we've got the wind at our back on that right now.
But you amazingly continue to expand the genres of content, which, as you guys have mentioned, clearly drives engagement. But the most recent new genre, which you introduced on your platform at the very end of last month, is fitness.
Just in time
And
for your New Year's resolution, yes.
I mean, but one class online could be the price of a Netflix subscription. So, while many of the workouts are bite-sized, I mean, some are longer, they're simple but deceivingly effective. Can you talk about what your plans are in this area? And, to the extent you develop more content, it really, as I said, drives value for anyone who would work out anywhere else. So how do you define success? And is there anything you could say about, partner economics with Nike?
Yeah, we can't comment on the partner economics, but I would tell you that we've historically stayed away from the fitness category because it's abundantly available online, in many cases for free, as you know. But we thought if we could partner with a great brand, and Nike is certainly a leading brand in fitness, with really well-produced content, which this content is, and then let's go out to our members and see if it's something that they value, and we'll see that in the engagement and see where we could take it from there. So I think in that way, working with a great partner and the high quality, to your point, of the content itself, will put it a really good test. Do people want to use Netflix to get in shape or to get back in shape? And if they do, we'd like to keep serving that. And if they don't, we'll keep poking around. So it's a way we're able to test the market at a very high end with a premium brand partner.
There's constant speculation that you will experiment with sports, which is an expensive rental business, for
Yeah.
many. Does having an advertising offering change your views on offering sports? And any thoughts that on like WWE, which is for sale, that could be potentially, if I'm just saying that could be owned content, like any views on sports?
Yeah, look, I'd say, in sports, our position's been the same, which is, we really, we're not anti-sports, we're pro-profits, and we've not been able to figure out how to deliver profits in renting big league sports in our subscription model. Not to say that won't change, we'll be open to it, but that's where it's at today. And in WWE, we look at, we have a lot of M&A activity all the time. We look at all of them, but nothing we can comment on.
Right. How does churn play a role in your investments into live events? While live comedy specials seem to have a value outside of the live window, other events, like you just announced that you're going to, host the SAG Awards, sports, obviously, these have fairly short, useful lives. So how do you balance the investment in live versus the potential to drive advertising dollars?
I would look at this as part of just like other crawl, walk, run scenarios where we are really looking at our content that would benefit creatively from being live. So the results show for one of our competition series that we have, or a reunion show that drives news, or like the SAG Awards, an opportunity to engage audiences live. And because we've got the shelf space, we can do hours of shoulder programming around the live event and all of those things that our members may enjoy. So there's nothing particularly novel about live television, as you know, but we are dabbling in it, starting with our Chris Rock live concert, to try to create the excitement around live for those things that are uniquely more exciting to be live.
Right. The theatrical release of Glass Onion was incredibly successful in its limited release, but so, for some, it looks like you left a lot of money on the table by not continuing beyond that 1 week. Do you have any regrets, or, can you give us your thoughts on your evolving film strategy?
Well, I'm thrilled with every aspect of the release of Glass Onion, starting with Ryan Johnson and his great film, and Scott Stuber and the film team for bringing it to the table. And I think what you saw was a lot of excitement. We drove a ton of buzz with that theatrical release, and we created a bunch of demand. And that demand we fulfilled on our subscription service. Our core business is making movies for our members to watch on Netflix, and that's where we're really focused. And everything else is really a tactic to drive excitement and around those films.
So, when you have like a massive global hit, like a Wednesday, there seem to be so many ways you could drive monetization. I know, like for just staying with Wednesday for a second, like the Wednesday makeup was sold out in every
Yeah.
Mac store in New York City. You could
Yeah.
not buy it anywhere. Do you participate in these types of consumer products, or is it just a way to, fuel fans, fuel engagement?
It's a little bit mostly to fuel engagement and fuel fandom. We do participate in it. Our owned content, we do drive a lot of revenue in our consumer products business, but mostly the motivation is to drive fandom. And Greg alluded to this earlier, but this impact on the culture that this content can have on our platform. In our earnings letter, we mentioned the Lady Gaga song that came back after 11 years because of Wednesday. But that doesn't mention the 4 songs this year that we actually jammed back into the charts. Some that never charted, and some that were off the charts for 40 years, from Metallica, Kate Bush, The Cramps. And that impact on culture, Sophia Carson's music career took off because of Purple Hearts. Jenny Ortega picked up 10 million social media followers in the first week Wednesday launched on Netflix. And all of these folks who build this gigantic careers on Netflix then go on to own their own companies, sell their own makeup in many cases, and become incredibly powerful influencers. And all of that business is drawn because of the impact that this distribution platform and this incredible UI that basically takes something like Wednesday, which was not a slam dunk for people to predict that people would love it as much as they do. And the UI could pick up on that activity in the early going of the release and push it out to where it's going to be, one of our most watched shows in our history all over the world. And we do use consumer products as a way to intensify fandom. And it could be anything from makeup from Wednesdays, you said, or maybe even a hand on your shoulder, Spence.
Yeah, you never know where Wednesday is going to show up, or at least think. I didn't get my chance to kind of talk and at the risk of going back to the management changes and say, I am thrilled with the changes. I'm going to miss maybe not seeing Reed as frequently as he's supporting Greg and Ted. So I just brought in a little bit of reinforcement with Thing, even though Reed's not going anywhere. But this way I've got a little daily reinforcement.
Sticking with content for a few minutes, the local language hits are building, but so are your US hits. How do you think about allocating your $17 billion or so content budget between genres or languages? Like, is there any way like you can kind of parse it out?
Yeah, it's a big task. Like I'm watching where viewing is growing and where it's suffering, and where we are under programming and over programming around the world is a big task of the job. Spence and his team support Bella and her team in making those allocations, figuring out between film and television, between local language and what's really interesting is there aren't that many global hits, meaning that everyone in the world watches the same thing. Squid Game was very rare in that way, and Wednesday looks like one of those too, very rare in that way. There are countries like Japan, and as example, or even Mexico, that have a real preference for local content, even when we have our big local hits. And every once in a while, something like Squid Game is even a big hit in the U.S. So think about in Q4, we launched a top 10 non-English series nearly every week of the quarter, from South Korea, from Spain, from Colombia, from Japan, from Poland. And so the benefit of that kind of local language investment and the benefit of doing that early was that we become exceptional on the ground in those countries. Those content teams generate not just content people want to see, but content that's leading the industry. To have Netflix produce the Academy Award entry film for both Mexico and Germany has never happened in the history of the Oscars. It's really phenomenal. And I mentioned earlier the All Quiet on the Western Front and the success of BAFTA. And keep in mind that these investments are important because it actually increases the total addressable audience for Netflix around the world. Because if we were just doing English content for the world, we would be mostly attracting Western-centric viewers. But our addressable audience is anyone who's watching TV anywhere in the world.
Thanks, Ted. Jessica, we have time for one or two last questions. Just want to make sure you have a chance to ask about margins or anything else you might want to ask about.
So let's move away from content then. So free cash flow, first of all, like what an inflection point, $1.6 billion in 22, roughly $3 billion in 23, $4 billion plus probably in 24. Can you talk about, historically you've been more build than buy. Is there any change in philosophy as cash starts accelerating? Can you talk about overall capital priorities and what's driving that operating margin increase?
Spencer, why don't you go first with the capital allocation philosophy, if you like.
Sure. Thanks, Jessica. So as we wrote in the letter, no change at all to our capital structure, policy, or allocation guidance, which is to first and foremost reinvest in the core business and selective acquisitions after that. Those are the main priorities. Beyond that, if we have cash in excess of our minimum cash levels, which is roughly equates to 2 months of revenue, then we'll return that to shareholders through our share buyback program.
Yeah, and I can pick up with margins. I can start with it's a bit of an explanation, but if you like, in terms of just in the near-ish term, our outlook for 23, and then just generally what's driving our outlook. But what you saw in the letter, and it kind of dates back, frankly, if we walk back to where we were in the beginning of 2022, when we saw slowing revenue growth, we said we're going to manage to a target operating margin of 19 to 20%. FX neutral at those January 2022 rates. And we ended the year at 20%, so at the high end of that range. And now as we kind of turn the page to 23, first I should say, with everything we talked about, we're quite optimistic in terms of our path forward. I also just want to highlight there is also a kind of short-term unusual amount of less visibility than typical, because these things we're talking about in terms of our revenue initiatives, whether it's scaling our ads platform, launching paid sharing, which hasn't globally rolled out yet. These things are early days, and then also, all multinationals have a level of macro uncertainty. So that's a bit of a caveat in terms of the variability in the forecast. But what we see is with our path to accelerating revenue growth and our high confidence there, that as we turn forward to 23. We're guiding to now 21 to 22% FX neutral operating margins at those same January 2022 rates. We're now in a new year, so we take it forward to January 23 to current rates, and that's a range of our operating margin guidance of 18 to 20%. So now FX neutral for 23, we're going to manage within that band to deliver at least within the 18 to 20% operating margin guide. So that is growing margins, growing absolute profit. And really what's reflected in there is that we have high confidence in our ability to accelerate revenue throughout the course of the year as we scale ads and we launch paid sharing. We've got high confidence in improving the service and the strength of our content slate with everything that Ted discussed here on the call. And we're also continuing to manage our cost structure with increasing discipline. You saw that in the back half of 22 with our slowing expense growth, and we'll carry that through similarly in 23. So that all lends itself to our focus, which is kind of healthy, growing, double-digit revenue growth and accelerating that revenue growth throughout the year, expanding both our absolute profit and profit margin, and then growing positive free cash flow. So that's all reflected again with the big caveat that there's a bit less visibility than typical in this near term. That's something we'll continue to work through. We'll obviously know a lot more over the next few quarters as we roll out paid sharing, and we'll update guidance as appropriate. But that's what plays through, and then also plays through to that cash flow generation that you see, where we believe with all those dynamics and managing at about the same level of cash content spend, that we'll have more than at least $3 billion of free cash flow in the year.
Thank you, Spence, for that answer, and Jessica for that last question, all your questions. And before I turn it over to Reed for closing remarks, I just want to say, as a longtime Netflix employee, formerly prior to that as an analyst covering Netflix for many years, Reed, it has been a real privilege to work alongside you. And on behalf of all Netflix employees, we thank you for everything you've done for us in the company over the past 25 years. And we're all super excited for the next chapter with you as our executive chairman and Ted and Greg as our co-CEOs. So with that, over to you, Reed, to take us home.
Hey, wait, Spencer, because I can't just deal with the thing. I just want to thank Reed as well. This is not a goodbye, I know, but it's been fantastic. I couldn't have asked for a more incredible experience of the past 4 years with you as our leader. Learned so much across everything from work to humanity, and I'm so thrilled with the next chapter with Greg and Ted and you, and so super excited, and thanks, Reed.
Reed, you might be muted.
You're muted, Reed.
Thanks, you guys. Certainly not goodbye. I'm heavily invested in Netflix success. It's been 83 earnings calls now. And I honestly have loved them. I love the interaction. But it's time for Greg and Ted and the team to lead, and I'll be in the prep sessions, but this will be my last earnings call on screen. Overall, I would say our first 25 years were good, and I'm super excited about Netflix's next 25 years being great under our broadened leadership team. Pleasing our shareholders and members is so satisfying, and I just want to thank all of you for your support and look forward to continued more progress. Thank you, everyone.
All right, team, that's going to do it for the earnings call. And I hope you guys enjoyed all the content that we had for you guys. On your way out, we'll see you tomorrow morning, bright and early on Pre-Market Prep.